How many times have you thought that the market is against me, or the market always goes the opposite direction of my positions? I know that it can feel that way, but honestly, the truth is that you're just making common mistakes that every new investor makes. Greg here is a beginner investor, and he is constantly making the same mistakes that you are probably making as well. Greg has lost thousands in the stock market, and yet he doesn't learn. Albert Einstein said that insanity is doing the same thing over and over while expecting different results. Well, that is the first mistake Greg and other beginner investors make. In Greg's case, he keeps investing money in biotech startups that often fail. He always thinks this company is going to be the next big thing. But the truth is, nothing will change if he keeps making the same mistakes. But that isn't everything. When Greg enters a position and it goes up more than the share is actually worth, guess what he does? He keeps it in hopes of making more money. And of course, he loses money since the value of the share wasn't as high as the price he had the chance to sell it for. Same thing goes if he watches a share go up in price every day and decides to enter after it had already gone up 50% in 2 weeks. Most likely, the value of the shares is under the price, and since he fears missing out on any future gains, he buys the shares at the top. A few days later, the price corrects itself to the share's value, and Greg's position was down 25%. This mistake is the one I see that most people do, and honestly, it can be quite hard to avoid this, since our emotions are powerful enough to make us do things we know isn't the right move. Another mistake Greg makes is he doesn't diversify his portfolio. You take on considerable risk when you invest in just one or two asset classes. If those asset classes perform poorly, your entire investment could be wiped out. Diversifying your portfolio across different asset industries such as finance, raw materials, retail, or tech is important. This way, if one asset's industry performs poorly, the others may offset the losses. Greg doesn't do any of this. If he believes that one stock is going to go to the moon, his emotions will want to secure the biggest profits possible and go in with all of his money. If this is how you invest, you might as well go to a casino. Apart from all of this, Greg doesn't even have a plan to become a successful investor, which is another big mistake many beginner investors make. Before you invest your money, you should have a clear investment plan. This plan should include your investment goals, risk tolerance, and time horizon. When you invest in an asset, it's important to have an exit strategy. An exit strategy is a plan for when you will sell your investment. Many investors hold on to their investments for too long and end up losing money. It's important to plan for when you will sell to take your profits and move on to the next investment. All Greg does is invest in random stocks that he thinks will perform well, and of course, that usually just makes him lose money. And if it happens to go up, his greed makes him want to keep it for an indefinite time. Don't get me wrong, you should absolutely invest long term, but if a stock that you just randomly pick goes up, that was most likely luck, and you should secure that profit while you still can. When Greg buys a stock, he just leaves it there and goes on with his day. A few weeks later, he notices that the position went up, but the day after, it went down again. Greg didn't check his position for a month, and that made him lose money. This is another mistake that beginners make. They're not monitoring their investments. Once you have invested your money, it's important to keep an eye on your investments. This way, you can ensure they are performing as you expect or make adjustments where necessary over time. This doesn't mean just checking the price every day, but reading the news about the company to know if it's doing well or bad. Every day, Greg is on his stock exchange, and he is always trying to time the market by buying and selling stocks multiple times a day. This is another mistake many beginner investors make. When investing, patience is a virtue. Often, it takes time to gain the ultimate benefits of an investment and asset allocation strategy. Continued modification of investment tactics and portfolio composition can not only reduce returns through greater transaction fees, it can also result in taking unanticipated and uncompensated risks. You should always be sure that you are on the right track. You should use the impulse to reconfigure your investment portfolio as a prompt to learn more about the assets you hold instead of as a push to buy or sell. So in conclusion, don't take too many trades. Not only that, but timing the market itself is a big mistake that many beginner investors make. They try to look at the charts and determine when the price is lower or higher, when in reality, they should find a business that they think is great and undervalued, and that has a lot of potential. Market timing is possible, but very, very, very hard. For people who are not well trained, trying to make a well-timed call can be a huge mistake. An investor that was out of the market during the top 10 trading days for the S&P 500 index from 1993 to 2013 would have achieved a 5.4% annualized return instead of 9.2% by staying invested. The difference suggests that investors are better off contributing consistently to their investment portfolio rather than trying to trade in and out in an attempt to time the market. But now Greg is tired of losing money, so he decides that he should start investing in index funds since he is not good at picking individual stocks. Greg thinks that he will finally grow his money, but since he is still a beginner, there's always something he can lose money on. In this case, Greg has found an index fund with a yearly fee of 4%. Investing in a high-cost fund or paying too much in advisory fees is a common mistake because even a small increase in fees can have a significant effect on wealth over the long term. Before opening an account, be aware of the potential cost of every investment decision. Look for funds that have fees that make sense and make sure you are receiving value for the advisory fees you are paying. Even 2% is high. I would be looking for fees that are under 1%. If the fees are higher or close to the average yearly return of the fund, your portfolio might not grow or even lose its value due to inflation. So, if you're going to invest in an index fund, you should invest in a well-trusted one, like for example the S&P 500. 2 years later, Greg still hasn't made money, but rather lost money in the stock market. All because he didn't learn from his mistakes, and that led him to losing thousands. Now he is completely fed up with losing money. He has lost so much money and it really annoys him that he can't make money without change. So he decides to actually take action and learn something from his mistakes. This means that he won't let his emotions take over. He won't trade too much. He won't choose index funds with too high fees. He won't try to time the market. He won't sell if it goes down a little and let his greed take over. He will start thinking rationally instead of letting FOMO, or fear of missing out, take over. And he will not make the same mistake twice. Fast forward 5 years and Greg has made tens of thousands of dollars in the stock market, and he finally isn't a beginner investor anymore. Now, Greg is teaching others about how he made many mistakes and that you should not make these easily avoidable mistakes that almost every beginner investor makes.